Hello everyone. Welcome to today's video on Bank Nifty analysis for the month of December. Here we are going to explore what are the possibilities and how market has reacted in the past. Over the years, we are going to take a quick look into and then see what would be the most appropriate strategy to employ in the month of December. While we are having another 8 days in November, why are we talking about December? Because December is known for high intense action month, and I'm going to show you what sort of reactions have happened in the month of December, and we got to have some sort of game plan well in advance because the kind of volatility will be super high, and while we are in the month of December, it will be very difficult to come up with a plan. Hence, we got to think what would be the logical way to approach the month that's going to come and have well laid out plan to deal with the volatility that's expected in another 8 days to start with. All right, let's take a look at what has happened in the past historically. I have mapped the price range for the month of December. We are in days candle, as you can see. And last year, if you see, we had close to 4,000 points of movement in one single direction. There was about 10 percentage gain, 9.2 percentage gain. And that's a story in 2023. And in the month of in 2022 December, we saw 1,800 rupees fall, which is about 4.2 percentage down. And here in 2021, you see that the market had fallen by about 2,800 points, and mid of December, it rallied up again by another 2,500 points. So it played both the sides with huge opportunities. First half, it went 2,800 points down, and second half, it went about 2,500 points on the upside. And if you look at 2020, then we see about 1,900 points of moves, uh, and that's about 6% of gain. And here again, there are first half we had about 975 rupees of fall, and second half we regained about 1,280 points. So close to 3% fall, and then 4% gain in 19. And here you can see that the market had fallen again like about 1,500 points, and then it regained about 1,100 points, 150 points, which is about 5.8 percentage fall and 4.5 percentage fall. And as you see in 2017, it gained about 548 points, which is about 2 percentage. Now, why we are more interested in this December analysis is you can see that the market was trading in the range of about 26,000 and 28,000, and the actual index value itself was very low. And to have 2%, 4% gain was pretty normal at that time. And we see that it's pretty much in a pre-COVID times where market was not showing too much of volatility. But what happened after 2020 is very important because once COVID happened, then the subsequent December months always had about 4.22 percentage is the least that we can see. You can see that there is a 6 percentage of action over here. There is a 7 percentage down and 7 percentage up action over here. And here you see that 4.5 percentage almost action over here. And here we have about 10 percentage of action, right? So the least that you can expect is about 4.22 percentage. That's what the data says. That's what the history says. Um, can it happen this time again? Yes, very much, because December is usually a lot of events. Financial year comes to closure for many of the IT companies. Then there is also Thanksgiving. There is also Christmas and New Year. So a lot of settling of accounts will happen, and then they are looking forward to the fresh year. So a lot of action keeps happening in the month of December, which is for sure can be expected at this juncture for 2024 as well. Now, what is that kind of thing that we can prepare? One, the least that we are seeing is 1,800 rupees of move, right? That is what has happened since COVID. That is the least that you can expect. But at that time, the market was at 40K. Right now, we have made a high of about 54K and currently trading around 51K, right? So the market itself has gained more than like 10,000 points, 11,000 points to be precise, as compared to the last uh, 2022 December. Since then, it has gained almost like 10,000 plus points. So we can expect severe volatility this year as well. And how you can plan for such a high volatility? Um, See, there are two scenarios. One, market having a single direction like this. This is one case that's possible. And another case is that market going down in one direction for the first half and then totally rebounding on the second half. So two scenarios are there. If that is the case, how do we plan? So one of the things that I feel could be a very good idea to keep in mind is to play, you know, strangles. That is what is in my mind. And remember, this is only for educational purpose. You can, try all these things that we are sharing as a paper trade, and then see how it works for you. And this is purely for educational purpose. Do not invest your money into this just because I am making a video and posting it online, right? You got to observe how these things are playing out for you, and observe and test, experiment as a paper trade. Then once you have sufficient number of testings done, then you may choose to invest according to you, what you feel works best for you. All right. Now, if this is the case, let's say market goes both ways. December 1st to December 15th or 20th, it is going up or down. And then from the second part of December, that is from 15th to 30th, it's like completely reversing. Then how do I intend to play? It's pretty simple. What I'm going to do is I'm going to create a strangle. When I say strangle, I'm going to talk about, so strangle, which means buying of options premium which are far OTM. Currently, we are trading at 51K, let's say, and I am looking at 50,000 put and 52,000 call, let's say, for example. And what you got to do is you should not be playing in current month expiry, because November. We are in November, and then if you are buying it, it will expire in this month itself. It makes no sense. So one of the things that one can experiment is to go with December month end contract. Um, it's all like personal choice. Maybe you're choosing a strike which is carrying a premium of around 300 rupees or 400 rupees or 500 rupees. It's all up to you. The higher the premium that you pay, the faster will be the break even. For example, if you are choosing 500 and 500, and then the market moves in either direction, say about 600 rupees, you will immediately start seeing a good profit on that, collectively put together. Maybe market is going up, put side will get butchered, but the call side will increase dramatically, and the differential gain will be much higher. In case if the market falls and then the put premiums are increasing faster and the call premiums are also depreciating, but then there is a differential gain. So this differential gain is what I would be playing for the month of December, because the volatility is super good. Whichever direction it takes, it's going to give you a good reward. Now I wouldn't be considering playing on single direction hoping that the market will go up or down. Say if I'm taking only calls and put or puts, and there is a say 500 rupees fall on day one, say that I average, then next day another 200 points of fall, again I average, third day it's going down further, again I average. How long can I keep on averaging it? At one point I will feel the pressure, and then as soon as I exit, the market may suddenly reverse, and might be I get into profits. But then it's physically and mentally impossible to stay calm when your losses are getting bigger on a day to day basis. Hence, it is not advisable for your trading career as well as for your mental health to have a directional view and then investing full throttle in that direction. It's not a good idea. So what I have observed is that over time, if the differential gains we were able to capture, it could be even like say about 100 rupees, but that 100 rupees is highly scientific and it gives you a lot of comfort. So uh, assuming that we play only December month in contracts, and probably people are very scared into buying deep OTMs. Sometimes they think that instead of buying 500 rupees premium single lot, I will buy 250 rupees premium two lots. It's all fine. As long as the moves come, it's okay. But the risk is if the market consolidates in a single place for you know a couple of days, then the 250 will easily become say 150 rupees in no time. But if you're taking something at 500 rupees, probably the market consolidates for 1 or 2 days. Hardly there will be some depreciation, maybe 50 rupees, 60 rupees on both the sides you will lose. That's okay. But 150 rupees, if it becomes from 250, then you will already start panicking. You badly wanted the market to move. So there will be a lot of mistakes. So the selection of what premiums is up to you, but generally you can choose a same premiums, say for example 500 PE, 500 rupees PE and 500 rupees CE. Now all that you have done is you have paid about 1000 rupees, correct, to the market. Now, the market, if it immediately reacts, if it immediately moves 500 rupees plus, already you will see some good profits. But unfortunately, the market stays for a couple of days on the same place, and then this has become 450, and this has also become 450. Now you need not 500 rupees of move, you need about 700 rupees of move. That's the challenge with this strategy. Okay, the market, the more it stays in a particular band, both the sides premium will be lost. But good thing about it is there will be an infused implied volatility. When suddenly there is a move in one direction, after a couple of days or maybe a week, you are seeing a blast of 1000 rupees in one direction, let's say. Then what it has to gain naturally, that will be there. Time value appreciation will be there. Um, and there is a premium that is dependent on the strikes that you choose. It will proportionately increase as well, but there is a sudden demand for that particular direction, maybe calls or puts, and there will be spikes in the implied volatility that will shoot the premium. So instead of something that should be trading at say if you got it at 500,000 rupees, it has moved. It should be trading at maybe 1,000 rupees, but instead it will be trading at 1,100 or 1,150 because there is a sudden spike in one single day. There is an implied volatility factor that will kick in. Now, what should be the exit strategy for such a move? It is all a personal choice. Once you have some sort of numbers, say for example, 1,000 rupees you paid, you are getting some 1,200 or 1,300. I will exit. 300 rupees gain is there. I will book it and exit. That's fine. Maybe half the quantity that you wanted to. Maybe you have taken two lots. You can book one lot and carry the other one. That is one way of doing it. Or somebody who wants to play really a bit risky game can also do one other thing. That is, um, wait for 1,800 rupees of move, because of all the last 4 years data, what it is showing is that in one single direction, it is going at least 1,800 rupees. So at least wait for a breakout of about 1,800 rupees. If not 1,800, at least let it move from the point where you have taken the position. Let it move about 1,500 or 1,600 rupees. Then you square off the position and freshly create another strategy of maybe premium of 400 rupees, because you don't know whether the market will continue to go up or it will continue to come down. So you can create a fresh strategy, right? That is another thing that you can do. So this is how I intend to play in the month of December. And why it's one way it is like foolproof strategy is that, see, the volatility factor is inevitable. That is going to be there. But what is so difficult about it is to see that your position can sometimes be in loss and the loss is getting bigger, and staying calm during that time is the biggest challenge. Which is why I'm explicitly sharing what I'm going to do, because although it can be said that you can try this, you can do this paper trading and then find it all, but in reality, when you initiate this position and you see losses and the losses are growing bigger and bigger, it requires tremendous amount of patience for you to stay calm and trust your strategy. So that is the biggest challenge. A lot of people, they try to make some sort of intraday, let me try something else, and then let me add some profit, and suddenly they will forget why they have initiated this trade in the first place. The first logic is that I am expecting it to move at least 1,500, 1,600 points bare minimum in one of the directions, which means it makes sense to pay 300 rupees premium on one direction. That becomes ITM at some point. You have got it as OTM, and at some point it becomes ITM. But people becomes restless, and if it consolidates for a couple of days, they just try to, maybe it is showing you a loss of about 2,000 rupees. Having invested 40K, you're saying 2,000 rupees loss. Maybe you wanted to cover the 2,000, you do something on an intraday basis, the loss gets bigger, and that is how people lose. So the retailers lose not because of a particular strategy, rather they don't have the discipline to trust their own strategy, why they have initiated at the first place, and trying to improvise it while you are experimenting. That is the worst thing that can you do. So these are the two common mistakes that people do. And if you have any further questions, comments, please feel free to put it in the comment section, and I will be happy to answer any questions that you have. Maybe if you wanted to know some sort of ranges, I can share it right now. Let's say the last range that you see here. Um, See, this is the peak, and the swing low would come from maybe the recent ones. If I take it is here. So on the downside, what is the correction levels? 49K, 48K, 46K that you see. In If you are going really really deep positional, then probably you can also consider from this point, which means 46K, 43K, and 40K. This is all like too much in the long term. But right now, we don't want to consider this. Let it at least come to this 48K. Then we can open up these analysis for real time consideration. Right now, it's very likely that during December I am expecting somewhere around 48K minimum, on the downside. On the upside, it can go all the way up to the lifetime high, 54K, 55K, it can reach. So December will be a pretty exciting month. Stay tuned, and I will keep posting more updates as we move further deep into the month of December. All the very best. Thanks a lot.